And so a lot of people took advantage. And now here in Arizona, people were, having to work here. They were doing all different types of reasons why they were buying here.
Yeah.
But they did, and our market just shot up.
Yeah.
So from 2020 to 2022, if you had bought in that gap, you saw a substantial increase in your equity.
We sold right before that. Every market, there is an opportunity. She goes, you just have to know where to look, and you have to know what to do. Welcome, ladies and gentlemen, to another podcast. I want to thank you for clicking on today's video. And don't forget to like, subscribe, hit that notification button so you know when the next video drops, and you will stay up to date on what we are doing. I'm glad to have our guest today. We got my cousin in the house, Anthony Delgado, D-Town in the house. And we're going to be talking a little bit about finances in this economic world, on mortgages in particular. So I want to thank you guys for clicking on today's video. And this is Ignite Fire. All right, guys, I want to thank you guys for clicking on today's video. So, Anthony, let's share with our audience a little bit about you and your background and why you're on the pod today.
Yes. So as you can probably see, we are both Delgados. We got the Delgado features, and again, we
look like family.
Exactly. So just a little bit about me. As far as finances, I've been in banking for over 10 years, personal banker, wholesale lending, and then home lending advisor, multiple areas there, call center and retail and everywhere in between. Worked for the big banks, some of the small ones, and just overall got a lot of different experiences on how people do business and how kind of a lot of the things work, especially in a corporate setting. So that's just a little bit on kind of what I've done and kind of where I've gotten my experience in this industry.
So since we're going to be talking a little bit about the finances and about home mortgages, especially with our Bidenomics that's out here on these streets that's taken people's hope away, what are some of the strategies that people can use to prepare for buying a house when the market is not favorable?
Yeah, good question. So first and foremost, you are definitely going to want to eliminate and lower your debts, which again is tough right now. We understand that. But if there is a plan or something that you can kind of put in place to get your debt down, that's going to be the first step in being able to qualify for more house.
Okay.
One of the major things that a lot of people do, which is just, again, what you don't know, is let's say you're going to buy a house, and right before that, you end up purchasing a new vehicle. Right? Now, if you need it, which again, you gotta do what you gotta do. But if there's a way to avoid it, get something maybe less expensive, really get that payment low. That's going to help, because once you put on, let's say you got a brand new truck, $600, $800 payment.
That shows your debt to loan ratio?
Your debt to income is going to be affected, and that's going to really make it tough for you to qualify for more home. So that's one of the really easy things you can do, is stick it out. Do what you have to do to roll with what you have until you purchase the home. And then after that, then you can go ahead and look at getting something once everything has been completed.
Okay. Something that my wife and I did. So we've been planning this for a few years now. So even before, pandemic happened, we were on this course, but we were saving up to buy land, build a house, which is a whole nother animal to skin. But what we were doing was, because we had to get a construction loan, land loan, you have to put 20% down payment.
Yep.
And with interest rates, we were like, what the heck? So we got kind of creative. And one thing that we did, so we sold our last house. We made a pretty good profit on it. And so right now, our down payment, everything, closing costs is about $84,000, right? And so we didn't want to just drop all that money and then all of a sudden now our bank account's cleared. So what we did was we got a little strategic. Now, I'm not a financial advisor, so you guys do your own research. I'm going to have a link in the description down below. There's a book called Become Your Own Banker, and you guys can click on that, and that's something that we were using for the strategy. But what we did was we took our down payment and opened up a life insurance policy that was strategically built for us. And we were able to borrow the money against the insurance company. While our money sits in the account building at 6% interest, we pull that money as a personal loan from the finance company, which the banks doesn't see because it's a personal asset. And now we're using that for the down payment, and our money's still growing at 6%. We'll pay ourselves back while we put the down payment on the house, which is pretty nice.
Yes.
And we were able to borrow against our own money within the first 30 days. Which is unheard of for most insurance companies, but we found one that would build that we built this insurance policy with, and so we borrow it within the first 30 days. Continues to grow. We pay our premium after the first year, and what's crazy is if I put in $500 this month, I can turn around the day after we put it in and pull that $500 back out, so it becomes this revolving door.
Yes.
So just
great.
kind of a cool little concept with life insurance, but do your research, guys, and to get a little creative with down payments. But
yeah, no, that's definitely a good one. And again, yes, we're just giving, opinions and general information here. Again, we know a little bit about, everything, but we're, again, just giving our opinion here. But that I believe is a whole life insurance plan as opposed to a term life.
Yes.
Now, most of the time they want you to do a term, which that one you cannot access.
No.
And that's the one that you pay until the end. Mm-hmm. So that was a good look by you guys finding the whole life, which again, it works similar to like a 401k. Mm-hmm. So I would say either that option, if you do get into a large sum that you can put into it, that would be great.
Yeah.
Because anytime you can get into borrowing from yourself as opposed to the bank, you're going to be better off.
Yeah. Well, and we're still getting the majority of our loan from the bank, so we just wanted to recoup some of our money so that way we can still have it. I heard it. So there's a company called the Money Multiplier. You guys we'll leave a link in the description. They're on YouTube, but he talks a lot about how to use this whole life policy. And so we called them, and interesting enough, some of them will use their policies for investment homes. They'll use it for stock market investments, and then they'll triple or quadruple their interest on the money that they have in their policies. They'll even become personal, hard money lenders and just borrow their own money and, lend that out while it's still growing at 6%, and then they'll make 15% off of it. I'm like, what the?
That's the way that they do it. Once you figure out how it works and how money works, then you can figure out how can I take advantage of that.
So tell us this. Here's another thing that people would probably need when they're trying to qualify for a loan is good credit. Do you have any opinions, ideas on how to fix or recreate someone's credit?
Yes. So that's definitely the other major part is the credit. And one other thing real quick on the funds part of it. I mentioned the 401k. You can also do a 401k loan. So if you've been at a company for 10 years and you've been contributing, you haven't touched it, they normally allow for a 401k loan, which is similar to that. But you, again, pay yourself back. They have terms available, and generally you can borrow about half of whatever your balance is. So if you've got $40,000 in there, you could borrow up to $20,000. You come up with a payment plan, and they actually allow for it to be used for a home purchase. So a lot of your 401ks, you can call them and say, hey, I heard maybe it can be used for a home purchase. They'll give you the terms, what, the rate, and then what the term of the payback will be. And it normally just comes right out of your check every month.
I'm glad you mentioned that, because when I bought my first home at the end of the crash of 2008, I used my 401k, and so my tax guy, he kind of walked me through the whole process because he was also my loan guy for the process, and And so I borrowed against it, and I got the what was it, a first time home buyers deal, and then used my retirement for the down payment, and then just paid myself back.
Yep.
So that's I forgot about that. Man,
Yep.
that's pretty good.
So that's the other one. So again, now one more on that real quick before we move to credit
Yeah.
is you can also get a gift. So they allow for that. Mom and dad want to help you out. Friends, family.
Y'all got some rich uncles and aunts.
They again, if they're willing to help you out, it is a gift. There is no repay back. So it does technically need to be a gift, but they do allow that. So you can kind of put these things together. Hey, I borrowed $10,000 from my 401k. I got a gift for $10,000, and you kind of put it all together to get to that number that you.
Now,
need
how
to
big
make
of
it
a
work.
gift can someone get?
There's really, I mean, I'm sure there is a maximum, but I
Yeah.
haven't seen one
Okay.
there.
Okay.
Again, when they're given a gift, it's gonna be a gift. It might not be everything they
Yeah.
have, so it might not be a huge amount. I mean, I've seen it for parents and
Yeah.
things like that, but a lot of times it can be a pretty good amount.
We had a financial advisor a few months ago, and he came on and he said that he ended up getting a gift, and it was a $50,000 gift, and all tax free, everything, because it was already taxed by the person who was gifting it. So that's actually pretty neat if you guys have someone that's rich in the family that's willing to help you out.
Yep. And another one that we're seeing right now is because of where things are at. As far as the market is for sale by owner.
Oh, okay.
So that's where, let's say, mom and dad, and you grew up in this house, you've lived there your whole life. It's worth $400,000. They only owe $100,000. Essentially, they can gift you the equity. So it doesn't need to be a physical cash gift. They can actually gift you the equity as well. So you would basically take over that $100,000 loan plus any money that they would want to make.
Yeah.
So let's say the parents are like, "Hey, well, we're going to give this to you. We just want $50,000 for ourselves."
Oh, dang.
If they owe $100,000, you basically can do a loan for $150,000 plus closing cost.
Yeah.
And then when that loan closes, the kids will get the house
Yeah.
with the $150,000 loan, even though it's worth $400,000, and then the parents will get the $50,000 cash that they want. And then,
Now that's not a gift though. That would be a considered a loan.
so the gift of equity is going to be the difference.
Oh,
So at
okay.
400,000 to 150,000,
Yeah.
that difference is the gift of equity that they're giving them. And then that's how people are doing it right now, because again, with where prices are at, maybe there's a house at a range for you.
Yeah.
Hey, go ahead and let's buy mom and dad's house, do that. And then later, once you're in a better position, you can then get, into something else.
Okay.
So that's just another one that I thought of. So
Dude,
there's two
that's
gifts.
actually pretty good.
yeah. And I've done quite a few of those.
Okay.
And so those do work. Now, as far as the credit, we can get into the credit. That is going to be the most important thing.
If people ain't got no credit, you ain't got no money. There's no way around it.
Yes, and really, what credit is your ability to repay, and that's what you need to show the bank if they're going to lend you probably the biggest investment that you're going to do.
Yeah.
And then if you have $1,000 credit card, but you're not able to pay that on time for whatever reason, maybe you don't understand how it works, didn't have the money that month, whatever the case is, it's going to be hard for them to lend to you on a bigger scale.
Yeah.
So you have to understand what you currently have on your credit and how to maximize that. Maybe you need more credit cards. Maybe you need some other, they call them trade lines.
Oh.
And those are just lines of credit, auto loans, student loans, credit cards, all those type of things are trade lines.
Okay.
So normally the bank is going to be looking at about 3 trade lines is what they want to see of at least 12 months. Now,
okay.
Again, it doesn't have to be that, but
That's what they're looking for.
that's kind of the baseline in most banks.
Okay.
Now, how do you get there, right? You're like,
Yeah.
I don't have credit. I don't even know what it is, how it works. So the main thing that you want to know is that when you do get credit, let's say you have a credit card, car loan, student loan, whatever it is, make sure you don't go past that 30-day marker.
Oh, okay. Okay.
So payments due October 1st. You're trying to put the money together. Even if you have to borrow, whatever you have to do,
make sure those payments are made.
Payment is made within that month, because if you go to the next month and it goes over 30 days, let's say it goes to November 2nd and you finally get it together, you're at 31 days. That's going to get reported to the credit bureaus, and that's going to show as a 30-day late.
Okay.
So that is one of the main things about credit that you want to make sure, by any means necessary,
make those payments
before the 30 days.
Okay.
And let's say you're just really in a bind, call the company. Don't be afraid to call. Hey,
that's good.
I'm in this kind of situation. Do you guys offer anything? Sometimes they might not, but they might say, hey, you know what? We could defer one payment for you.
Yeah.
And then you can start fresh the next month. Or we have this program that we're doing.
Yeah.
Or any way that they can do it to not report it late.
Yeah.
That's something. So don't be afraid to call the company, call your creditors, let them know what's going on so they can help. Don't just hide.
I know. I'm going to tell you guys from personal experience. don't hide from your creditors. So I had a pretty nice Honda car. It was the 2-door Accord, really nice red car. And I
remember that one.
I couldn't make a few payments, and every time I called, they would really just honor it, and they would push back a payment. Then they did 2 payments, and then I would pay, and then I'd have some trouble again. And they kept pushing it back. They were working with me, but the moment that I didn't call them, and I started to go into that month late, and then I went to the second month. I went outside and I thought my car got stolen.
Dude, where's my car?
Hey, where's my car? My car got taken to its rightful owner, the bank. And I realized real quick, fast, in a hurry that you got to stay on top of talking to those creditors.
And it happens. So that's why. And then you've seen the TikTok videos where the tow truck guys are in, and they're in and out. They're getting good. It's like you can't really.
They're ninja quick.
Yes.
They're coming in, swoop, they're gone.
So yeah, definitely stay on top of that. And again, they'll work with you. Even if you do go late, let's say worst case, it does get behind, but it doesn't get repossessed.
Yeah.
You can get back on track. So don't think that, if it's over, I can't do
Don't throw in the towel.
Don't throw in the towel, because if you let it go too far, and this is what the next step is when you don't make the payments, is once they get the vehicle or whatever the what you owe on that credit line, it's going to then go to collections if you don't take it from there. And then that now becomes another issue, because then that's going to take the whole amount to get it off your credit. You can settle. There's different things, but you can lose, I've seen, up to like 50 points off your credit for something, reporting.
So my credit was destroyed, ran through the mud, and it was terrible. And I remember I had a lot of equity in my house, so I ended up selling my house and then negotiating with the creditor, and it was pretty awesome. I was able to. I think I owed like $15,000, and they dropped it down to like $6,000, just to settle the debt. And I was like, oh yeah, okay. When do you need the payment? They're like, yesterday, and I'm like, yeah, well, I'll pay it today. And so I ended up, you can settle sometimes on pennies on the dollar when you talk with them. And some of those people are mean. Oh my gosh, this lady, she hounded me night and day. I was getting anxiety just to answer my phone. I'm like, these people are crazy. But I have fixed my credit since then. That was over 10 years ago. But just a little hack again. We're not advisors, but this is something that I do and have currently still do today. Is I have a Southwest credit card, and it's a business card. So all of my normal expenses, my gas, my chemicals, everything that I spend on a normal basis, where I would normally pay cash, I put on my card, and then at the end of the month, I pay that thing off. And my credit score is almost 800 points now.
Yep.
Just because I my normal monthly expenses, I'm on there, and I kid you not, I have 180,000 flyer points on my
Wow.
credit card, so I can like I can fly to here to Miami with 50,000 points and do all
Wow.
kinds of cool stuff.
So
But
you're ready to go.
yeah, yeah. So I just
Nice.
let that pile up every year.
Yep. Yep. No, that's good. And that kind of goes into something else, which is called credit utilization.
Oh, okay. I like
So
that.
there's a reason why they look at those things. Now, if you get a credit card and they give you a $5,000 limit on it, right? Okay, great. Well, you go out and over the next few months, you rack up $4,500 in debt,
Ooh.
right?
Yeah.
You're like, hey, this is good money, right? And I
Yeah.
did it in college. I
Yeah.
didn't know. I signed up for something I didn't know. And next thing you know, a card came in the mail.
Yeah.
And then there you go from there. So they make it very easy for you to get the card, but you got to make sure you understand
Yeah.
how to use it. So credit utilization is what is my balance and how much have I used of that?
Because you can use more than 50%, right?
You can use 100% if you want, but when that reports to the credit bureaus, that's dramatically going to affect your score.
Yeah.
Because that alone is 30% of your score.
Oh, okay.
Okay. Now, what you're doing without even knowing it, or just, you've gotten better with credit over the years.
Yeah,
So
yeah.
you've kind of put your own stuff in place of this is how
Yeah.
I work it, and it's making the score go up.
Yeah.
Your credit utilization must be very low.
Well, what I screwed up with in the beginning was I only had a $5,000 balance. And so if I hit 2,500, 3,000, my credit would drop. And then, and I was like, what the heck? And they're like, you got to increase, they're like, you got to increase your credit. So I ended up getting like 15,000, but then I still just use my normal per month. And then that radically changed my credit
Because
score.
you changed your credit utilization.
Okay.
you
So
went
that,
from
see, I didn't even
5
realize what I
to
did.
15. Now, you didn't change your spending habits.
No.
You just got a higher limit increase. And that probably took you from 70% to 25%. And when that reports, that's where your score is going to definitely go up. And that will be month to month.
Yeah.
So
Yeah.
you could be 1 month where you used it and you didn't pay it back, your score is going to drop down. The
Yeah,
next month,
yeah.
you're like, oh, I just paid it all off. You'll see it go right back up.
Yes.
So that's the quickest way to get your score up
Oh, dang. Look
is
at
do
that.
your credit utilization. Again, it's tough because everyone's looking for extra money right now.
Yeah, yeah.
You know, we're having to put money on the credit card as opposed to, putting it in the bank as cash.
Yeah.
So
I think that's where I think the average American needs to tighten their belt buckle on and get down to the nitty gritty and say, hey, if we can't buy it, we can't buy it. And I really would discourage using any kind of credit unless it's your normal cash flow that you're already going to spend and you have it. Because then it does get out of control pretty quick. And I've had that happen to me quite a few times. And I'm like, no, I can't do that.
Yeah, and a good rule is if you can spend what you have. Okay, I'm gonna put $100 on here, but I have 100 in the bank that I know I'm gonna pay it with.
Yeah.
Now life happens sometimes. Yeah, I had to put a little more than I wanted.
Yeah.
But make sure you got a plan to pay it back.
Yeah.
And that's gonna keep your score in a healthy condition.
So guys, I'm continuously discovering new things because of my own habits. But I started a secondary business, right? And instead of getting a loan, which I probably should still do, get a small business loan, I opened up a credit card and put everything on the credit card, and now that's taking time to pay off. But luckily, it was under the business name, and it's still separate, so it's not affecting my actual credit.
Your personal.
Yeah, it's showing under the business, but I'm still a guarantee to it.
Yeah.
But it's not dinging me on my personal credit,
Yep,
which is I'm
yep.
thankful for that.
And that's good. Yeah.
Don't do
exactly.
that.
Yeah. So generally just try to keep it under 30%, really under 10%. And then if you can, pay it off every month, which is
Yeah.
what a lot of people like to do. And I'm gonna probably guess if you look at their credit scores, is gonna be on the higher end.
Yeah, and then if you guys ever listen to Dave Ramsey, one thing I do really like that he does, we've used it in our own life, is the snowball, the debt snowball, and you pick a payment out of all your other ones, you knock that one out, and then you use that and you hit the next one, and you just keeps growing with each one. My wife and I have done that. So the only thing we owe right now is our property, and I have a car loan and my business loan, which my business is only 9,000 or 8,000, and my truck is only 4. So before we use all of the down payment for the house, we're going to pay that off, and then we still have enough for the down payment, and then so that's going to be clear, and then we'll just have our house and our land. So getting rid of everything.
That's good because you're going to get rid of those payments.
Yeah.
So that's what's going to end up holding you back if you end up going to purchase, and then it's like, well, I got this payment and this payment. Because what happens is, and we'll get into it in a little bit, but just to give a quick example, let's say you make $60,000 a year. Okay. Now monthly, that's $5,000 a month. Most banks are going to let you borrow up to 50% of your gross income, which means before anything comes out, before taxes, before the 401k. Okay. Now, if we take 50% of that, then you're at $2,500. Now, that $2,500, you need to fit all of your other payments
within that,
the mortgage payment that you're going to have.
So you almost need a dual income a little bit. That would help, right?
If you're going to have higher expenses, then you're going to need either a dual income or a good income.
Yeah.
Or, like I mentioned, you're going to need to get rid of the debt.
Okay.
Because now you can use all that if you have no debt. You're like, hey, I'm debt free. Okay, perfect. Well,
now it fits right in there. Okay.
But let's say at $2,500, well, I got a $600 car payment.
Yeah.
Okay. Well, now we got to subtract that out. And then you're like, oh, I got a credit card that's $100 a month. So now we got to subtract that out. So just those two things, and now
$1,800 just from
you're
there.
at $1,800, and again, you can get approved more than likely, but what amount will you get approved for? It may be lower than what you need.
Okay. Now, does the interest rates affect that too?
Yes,
Okay.
Definitely. So that's the other reason why, right now you don't want to overextend, and you don't want to have heavy debt, because even car loans, home loans, all the interest rates are up across the board.
Okay.
And so if you go buy a new car, that's a higher interest rate. Then you're like, oh, now I'm going to go get a house. That's going to be a higher interest rate. You're going to be really increasing that debt to a level that might be more than what you can handle at that time.
Yeah. Okay.
But yeah, interest rates, definitely you want to take that into an account. Now, car loans, a lot of times they're going to give you the interest rate. You can shop around with different banks, lenders, credit unions, find that best rate.
Yeah.
On the home loan side, the mortgage side, you can buy down the interest rate. So there is an opportunity there to get a little bit below market, and we can kind of go over those a little bit later. But that's one way you can kind of try to combat the higher interest rates with buying down the rate.
So is that would that be like, say we get a house now, it's 7%, and just say things fluctuate throughout the next year or two, and then it drops down, we'll say back to 5%, 4%, maybe not going to happen. But if it's something like that did happen, is that where you could redo your loan and get the better interest rate, refi your house? Okay.
Yeah. So the saying is that, again, this is what I've heard. This is what I use.
Yeah.
Is you marry your house and you date your rate.
Oh, what?
Okay.
I like that.
Yeah. So again, get the house at the right price.
Yeah.
If interest rates are higher now, then again, you got to afford for that. But later on down the line, you can potentially refinance that into a lower rate, and now you're going to be in a much better position.
Yeah, because you could you qualified it at a higher rate, so now you're doing a lot better. Okay.
Yes, so that's definitely something that you can do, and again, it's just not overextending. Get something that's affordable, so if something does happen, you're not going to be in a bind.
Yeah.
And but that is something you can do down the line for sure.
You know, I've always heard from a lot of people. It's kind of mixed back and forth. Some people say, "Hey, it's better to rent instead of own." Other people are, you know, it goes back. Hey, it's better to own than to rent. I personally think it's better to own, just because you're paying that mortgage, and you got interest that's building. And so I've always been in a home that we've owned for 2 years, 3 years, and then we've had, you know, maybe 50,000 to 100,000 in equity, and then we sell it, and then we do something else, or we upgrade, we get a better house, or, you know, we just keep building up. And I know some people that have done that, and instead of getting a better home, they'll diversify and then buy 2 homes, one to rent and one to live in. And then as that interest rate grows, then they'll sell those after a few years. But then you kind of you don't do as well on your rental property with the financial gains or capital gains.
Those are long term.
Yeah.
So those are long term gains that you'll see down the line once you've paid the loan down. Now it's worth more. You'll see that. A lot of times, right now, as far as renting versus buying, because that's really it's a big question, and everyone kind of goes through it. One is, can I afford a house? That's where you want to go to a local lending advisor, find out where you're at. Don't say, you know what, I don't qualify. I know I don't qualify, because you really don't know.
Find out first.
Find out, do it, go through it. They're going to tell you, and a lot of times you may.
Yeah.
Now, a lot of times you'll find out, well, my credit is done. I had this, and you think it's this and that. Well, then you might look at it and go, oh, I was actually better than I thought. So go find out.
Yeah.
See where you're at, because then you can come up with a plan.
That, I think, is one of the biggest things for those who are watching. The plan, having the plan, that makes a big difference.
And that plan may include credit, building credit, repairing credit. It may be down payment. That's what we need to work on. It may be income. I got to get my debts down. I got to get my income up.
Yeah.
So those are all things that once you kind of do that consultation, you can go, okay, now I know what I need to work on.
Yeah. Yeah.
Prior to that, you really don't know.
Absolutely.
And that's really how you kind of get to that goal, because my first house that I bought, knowing or unknowingly, I was on Tony Robbins at the time.
Oh, okay.
He had the little CD. It was the CD. It was 4 or 5 different ones.
Yeah.
And I would listen to that, and he would have you write down, what are your goals? What are you looking for? What
Yeah.
So without knowing, I'm coming up with a plan.
Yeah. Yeah.
And then unconsciously, daily, you're working that plan, even though you know it or not.
Yeah.
Because you built the roadmap.
Yeah.
Now, if you've got no roadmap, then guess what? You're like
just
out
floating
camping
in
in
the
the wilderness. You're floating in the ocean. You're like, I don't know where I'm going.
Yeah.
But if you put the plan together, you can set the compass. Okay, I go this way, then this way. You're going to end up there.
And if you don't know where you're going, you won't know when you get there, guys. so it's important to know, you know, that we've been working with the banker, because our whole plan was to buy land and build a house, right? And then we didn't know where to start, what to do, so we started interviewing banks, you know. And then they found then they located where we were, and then we found out there were only like 3 banks here in Arizona that would do a construction loan and a land loan together, and we started learning all that.
Yep.
And then we needed to learn how much money that we needed to show on our income versus how much down payment we needed. Then we needed to find a builder that qualified with that bank, and so this has been a 3-year process.
Yes.
Of buying land and building a house. But right now, after 3 years, and those who don't have a plan or don't have anyone, it's important to find someone, a banker or a bank that you are wanting to work with, because he really helped develop our plan of action.
Yep.
from the down payment to the builder to how do we qualify, to what do we need, to show on our income. And so every year we've changed something to get closer to that goal.
Yep.
And then we even, it was even a process to try to find an architect to build us the plans. And that was another thing. We're like, oh yeah, it's gonna be like $3,000-4,000, $10,000 later just to get plans on a piece of paper, and I'm like, oh dang. And then there was one point where they told us we needed $160,000 down. And we're like, we can't do that. But then as things changed, and then our income, and then he's like, okay, now you need this. And I'm like, oh man. So we're finally at a point where we're able to finally move forward. Yeah. But you're absolutely right. It was important to have, it was almost like having a coach to say, okay, you're here, you got to get here,
Here's how
fill
we
in
do
the
it.
blanks,
Yeah. The roadmap.
It's the roadmap.
You got the roadmap, you're going to get there.
Yes.
So, and that's another quick thing, now that you mentioned that, is with self-employed income.
Oh,
I'm sure that might have been something you ran into, because what happens is when you're self-employed, obviously you do not want to pay as much taxes as maybe permits.
And that hurts you.
Because
another personal experience.
I figured you went through that, and I was self-employed as well. So it's like you kind of figure these things out. But, for example, let's say you start a business, you made $250,000 in total sales, but you had to start the business. So you had this expense, that expense, you had everything in there.
$50,000.
and you ended up paying taxes on $50,000, which is not bad. But the banks have to use that number to qualify your income for self-employed.
Yeah,
and they use the 2 years. And so again, and that's where you probably had to make some adjustments. Where it's like we're going to have to end up paying more taxes because we have to have an higher income to reduce our down payment, and kind of it all goes together. So that's why, luckily, you found someone that was good, that kind of gave you guys, hey, here's kind of what has to happen in order for this to all make sense.
And what's crazy is I've never paid more taxes than I paid right now to qualify for this loan.
Yep.
And one of the rude awakenings that we had was I kept putting a certain percentage to the side. And at the end of the year, I realized that wasn't the right percentage we needed to put to the side. Yep. And then we had a lot more taxes that we needed to pay at the end of the last 2 years. And so do you know what the average percentage for a business owner should be to put on aside for taxes? I can't remember. This is just advice, opinions. I can't remember. I think my banker or my tax guy was saying somewhere between 12 and 15% just to put to the side. Don't touch it. Just leave it there.
Yep.
Just for whatever reason.
Yep.
For taxes.
And then you may be a little higher, a little lower, but at least you're gonna have the bulk of that. Yeah. And that's the same even for not self-employed, even a W-2 job.
Oh yeah.
When you do your elections for your taxes, I believe it's a W-4, that's gonna be how much of that is coming out of your check. So that's why some people like to take the max out.
Yeah.
Because it kind of saves the money for them. And then at the end of the year, you get a big refund.
Yeah, yeah.
Some people are like, I want my money right now, so let me do the minimum, and then I'll figure it out at the end of the year. Now, again, everyone is different, however you want to manage that, but that
you only do that for a little while until you realize, oh, man, like Dave Ramsey will say, buy term and invest the rest. Most Americans don't invest the rest.
No.
And they're living beyond means, and then at the end of the year they're like, oh man, I didn't.
Yes.
And then that term policy those life insurance term policies are only for 20 years. Then you realize halfway through you're like, oh man, I didn't invest for 10 years. I need to do something with my money.
Yep. Exactly. So no, that's definitely good. So yeah, credit definitely important. Three trade lines, and making everything on time. Score wise varies between different lenders and banks. So that's why you want to just go kind of see where you're at. You know, you may think it's not high enough, but you know, there's banks out there that are lending with certain credit scores. So, you know, definitely get the roadmap.
Okay.
Again, right now it's really just working on getting those expenses down. Like you said, come up with the snowball effect. Either attack the lowest balance that you have and get it to a zero balance so that you're not paying interest on that anymore, or find your credit card with the highest interest and work on that, because then you're going to eliminate the one that has the highest interest.
Yeah.
Those two are really good. And again, right now, which a lot of people are doing, is maybe look at a second gig, a side hustle, a part-time job, some way to start bringing in funds and start kind of getting it the other way. Let's say your debt is kind of stacking up. And this is, for the most part, I think, is that savings accounts are getting depleted right now just because of where things are at. And then once that happens, then you're going to go towards credit. So really, you want to eliminate that as soon as you can, where it's like, you know what, let me pick up this side, job, this part-time job, so I can stop that from happening and maybe keep the ship steady until things start to turn, and then you're going to be in a much better spot. And then again, I don't know if we want to go into it, but as far as like the roadmap for once, let's say you've purchased the home, then you're going to have a few options after you purchase the home. So I think you were going over rent versus buy.
Oh, that's right. Yes. Yeah.
So I wanted to go back to that real quick. Yeah. A lot of times what I'll suggest, especially right now, and depending on where you live, things are all different. But really what you want to do is, what am I going to pay for rent? Take that number and go find out, what does a mortgage look like for that same payment?
Yeah.
Because if they're going to take your monthly rent to $2,500 a month, which is probably pretty average right now for a 2-bedroom, 2-bath, something like that, then look at that compared to, okay, if I qualify for a home, what does $2,500 get me? And then at least you're going to know, okay, now I got my options.
Yeah.
Like you said, you went to the purchase, which helped, because then you were able to build equity. You were able to get the interest on the, taxes, and then you were able to use those funds to then make another purchase.
I was looking at like, how much money can I save versus if I bought a house, how much equity could I build in that same amount of time? And it just made sense, because I couldn't save enough money. I couldn't save money faster than the equity would grow. So I was like, okay, let's do that.
and then again, you got to think of it that way. It's like, okay, I was in the house 5 years, and let's say I made $75,000 in equity. So think about your job that you work every day. How long would it take you to save $75,000?
Yeah.
Right. So that's how you have to look at it. And then it's like, yeah, you know what? And it's going to something. It's going, I have control of it. I own it. I can make changes. So those are all pride of ownership.
Yeah.
It definitely goes with that.
One thing you just reminded me of something I heard from Andrew Tate. I don't know how, but he was talking about how he lived with his brother, and they family lived together, and what they ended up doing was building a business together, and so they all shared, the mortgage, the rent, all the utilities, and he had mentioned how there was a family in their neighborhood. There was like 5 families living in one house, and they strategically started buying each house on that block, and they all shared one house together until they owned all these different houses in the whole entire block, and then they like dominated the housing market in that area. But they all stayed together and sacrificed for years until they owned like 6 houses in the neighborhood.
And that's a strategy. It's a good strategy, because what did they do? Their expenses were down.
Yeah.
They had very minimal expenses.
Yeah.
So when you do that, then you get opened up, right? Hey, I'm going to move back in with mom and dad for 2 years.
Yeah.
Save up, get ready, and boom, then get ready for the purchase. So everyone's different depending on your situation and kind of where you're at in life. But
That also reminds me too of, because I was thinking of my son and even 5 friends coming together and getting a little apartment, but coming together for the purpose of, hey, can we build a financial house that we are, business together? But then you get different people, different ideas, different. But if you guys can come together on it for a main purpose, then you got 5 incomes that are getting ready to buy real estate. And I know there are real estate companies that will take in like 100 investors, and they'll all come in and invest to have a bigger buying power.
Yep.
So if you took 5 friends that are all working and say, hey, let's create a little trust or an entity that's going to be our buying powerhouse, you can end up buying houses in the market.
yeah, yeah.
Another little
strategy.
tidbit.
Yep. Again, and that's just coming up with a plan.
Yeah.
Whenever you come up with a plan
Yeah.
and you execute it, you're gonna end up getting there. Now, one thing that happens a lot right now too is multiple people on the loan for the income.
Oh, how many people can be on a loan?
So it can go up to, I've seen 4. I don't know if you can go more than that,
Yeah.
but that's what I've seen is 4.
Because if it goes sideways, that can get a little messy, huh?
Well, and again, if you know up front and you have the plan. So let's say son and wife qualify with the parent. All 3 of them. We need all 3, for the loan to work.
Yeah.
Now, the house is going to be for the son and the wife, right? What happens is, as long as you do it the right way when that happens, which is the son and the wife are going to make that payment from their account directly to the mortgage company, then that's going to show that the parent was actually a co-signer.
Oh.
Now, when you do that for 12 months, you can show the bank, yes, we all qualified,
Yeah.
but they're the ones making the payment. That will free up the parent
Yeah.
to go ahead and be able to buy their own place, even though they're on that loan. So that's something that I think people think of a lot, and they're like, I don't want to go on that because then I'm going to be stuck when I want to go buy my house.
Yeah.
And again, that's not always the case.
It's part of the plan. It's got to be, you got to have the plan pre-made.
Then you can do it. The other way you can do it is, let's say you didn't have 12 months. Well, then the parent can say, well, I'm actually going to be renting this house to my son and wife. So I'm going to go buy another one, and then this is going to become a rental for them.
Oh, dang. Okay.
And you can put it in a lease agreement, do the deposit, and then they live there, which is essentially what they're doing.
Yeah.
And then you use that lease agreement.
Just how you frame it.
And that's going, and then basically what that's called is a conversion of primary.
Yeah.
So you're converting from this house to, you're going to buy a new primary. So as long as you buy the new house and you rent the old one within the similar time frame,
Yeah.
then that lease agreement will offset your mortgage payment. So now that mortgage is not going to count against you. You're free to use all your income for the new house.
Yeah.
And that happens a lot. And that, again, is something good to do if you have a low interest rate.
Yeah.
So if you're in the 3s, 3.5, and you're like,
And there's a lot of people that held their houses through all this craziness.
yes,
They were at 3. I wish we would have held our house because we were at 3% interest on our house. Our mortgage was $1,200. I'm like, gosh,
yes.
dang it.
Always hindsight, and the same with me. And again, guys, don't go back and look at what your house was worth that you sold.
Don't do it.
Stay out of there. Get off of Redfin and Zillow. Do not go look.
You look at that morbid reflection. That's what I call it.
It's just not good. Don't drive by it. On your way home, just stay away.
You start, oh gosh, yeah.
But yeah, so that definitely, that's a way to do it, to maneuver. Again, if you have a plan, hey, we're going to buy this house, we're going to keep it for a year, we're going to rent it out, then we're going to buy something else. Again, have it all in place, and then that's how you build your generational wealth. Because now the son and wife have a house. Now dad's buying another house.
Yeah.
Now the son and wife in another year or two, they can do the same thing, make that a rental, go purchase a new one, and now you start building
Yeah.
like the family that you said.
It's monopoly, guys. It's monopoly.
Yep, yep. So yeah, no, that's definitely a good way to do it, and it's just having that right plan to put
Yeah.
it in place. See the advisors, like you said, you talk with them.
Yeah.
They give you the roadmap. You stick to it. You're gonna get there.
Like right now, after we build our house, we're gonna have an instant like $250,000 equity in the house after it's built, and then we'll be paying off our life insurance that we borrowed while our money's still growing. And then once that gets full to capacity, we're gonna take that loan out again, and I'm gonna use that as either hard money lending or the purchase of more property. So
Yep.
that's kind of like our little plan right there.
Yeah.
And actually it started with speaking to a banker
There you go. There you
and
go.
doing research on podcasts like this. Like I found someone talking about life insurance. I'm like, hey, I think we could do that with our down payment. And since we already had it, and all the different research, and just got creative. Don't ever lose hope that you can't accomplish something. It may take some time, it may take a little longer, but every day you could be working towards something. And don't ever lose your vision or your dream, because that's really how you develop the plan. It's like, what do I want? And then you kind of re-engineer that backwards to where I'm at today and say, okay, this is how I'm going to get there. And things happen, things change, sometimes better, sometimes worse. And you just re-navigate towards that goal.
Yep.
Yeah.
And then I guess the last thing we can go over is just kind of the market trends.
Oh, okay. Yeah. Let's
Where
talk
is
about
the
that.
market? And again, I'm going to
Dun, dun, dun.
Yes.
What is going on with the market and the election? We're not going to get into politics, but
Yes.
this Bidenomics is not good for the average consumer.
yes, everything's up. So again, these are trends. And so I'll preface this by saying that none of us have a crystal ball.
No.
Right? Again, we don't know exactly what is going to happen. We can only go off of the trends that we see.
Yeah.
So so essentially, as far as the housing market, and we're here in Arizona, so I'm going to just kind of use that as the example. Basically, what happened is, obviously, when the rates went down to the 3s and even in the 2s, I know some people are sitting there with the 2.
Yeah.
If you do not touch it. Figure out a way
To keep your house.
to keep that 2%. And I know there was a lot of people that took advantage of that. But what happened was, once the rates went all the way down, and this is kind of just the trend of how the market works in general, that became very enticing for people to go ahead and buy.
Yeah.
Because now you've got a low rate and that payment is going to be low. Okay, so now they're looking at it going, well, I can afford more house now. My income wasn't affording me that much house when I last checked, but now where the rates are at, now I can afford more house.
Yeah.
And so a lot of people took advantage. And now here in Arizona, people were, having to work here. They were doing all different types of reasons why they were buying here.
Yeah.
But they did, and our market just shot up.
Yeah.
So from 2020 to 2022, if you had bought in that gap, you saw a substantial increase in your equity.
We sold right before that.
Oh, no.
Don't look back. Don't look back.
But you still came out on top,
Yeah,
right?
we still came out on top. Yeah.
Okay, there you go. That's the name of the game. As long as you don't lose.
Yeah, we didn't lose.
There you go. So, so during that time, everything went up.
Yeah.
Now, what happened was the demand got out of control. And that's when here in Arizona, there were lines out the door to look at houses, and things were going 20, 30, 50,000 over asking. And what that did is people ended up paying more than what the house was actually worth.
Yeah.
Right? So when the rates went up, that was more of a way to kind of even out the market a little bit, because they had to slow down.
Yeah, they put a big stopper on it with the interest rates.
Yes, and the way that they did that was they increased the rates to make it not as enticing for people to go into the market.
They were effective at that.
And that did work. Now,
Yeah.
there's other factors involved, but
Yeah.
the easiest one and the main one that they use is the housing market.
Yeah.
So what happened is everyone got at the high price. When they raised the rates, then what happened? The demand went down, and then what does that do? Now sellers have to bring their price down.
Yeah.
Before there was too much demand, and then
not
prices
enough.
went up, 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 up.
Yeah.
Once the rates flipped, then now the demand went down because everyone's going, I'm waiting on the sidelines.
Yeah.
I don't think I'm going to get into that. Those rates are too high because
Yeah.
we did get spoiled with having them that low.
Oh, yeah.
Historically low.
For the first time ever.
Yes. And so to have that, now again, historically rates are not that bad,
Yeah.
even where they're at now.
Well, I remember, I think I was talking to my mother and father-in-law when they bought, rates were like 12%, like something crazy like that. But their house was like 70,000.
Yes.
You know, but it was like
Yes.
still.
It still was up. And
Yeah.
so historically, we're still not bad. But when you look at where we came from, it's hard to kind of
Yeah.
get your mind wrapped around that because we were in the low interest rates. So basically what happened is they had to slow down the demand. They increased the rates, and then just like they probably anticipated, prices came down.
Yeah.
So prices came down, and everyone started saying, "Oh, it's going to be 2008 again," and it's all these different things. Now, again, we don't have the crystal ball, but it didn't quite happen.
Yeah.
Now, it did come down.
But not like it happened with 2008 because it's a different, it's
in
a whole different scenario.
We're in a different time now, and to think, and again, anything could happen, but to think that it could go back down to that
Yeah.
is hard because,
Yeah.
and you kind of have to wrap your mind around that because as you grow up and as you get older, you know what it used to be. So you have to go, well, it should go back to that. But really, it's like, no, we're in a new world. We're in a
Yeah.
new financial market. So it did come back down. Now, there was a little bit of a dip where it went down, down, down. And then what happened? People said, I got a family. I'm moving here for work. I'm leaving my state. I'm going to another
And a
one.
lot of people came to Arizona and they're just like
And-
building houses like crazy.
And a
everywhere.
lot of people came. And so what happened was after that initial drop, the demand slowly came back. And people said, we're going to date the rate, right?
Yeah.
And we're going to muscle it
Yeah.
and we'll make it work because we got a family and we
Yeah.
need somewhere to live and we don't want to rent.
Yeah.
And so
And the thing that's different now than it was before they were doing a lot of balloon interest rates, right? Where this is maybe a solid, it may be high, but it's a solid rate where you're not fluctuating.
the banks learned, and from last time, there were two things they were doing.
Uh-huh.
One was they weren't verifying income.
Okay.
They were doing
They're really making sure we're verified today.
yes. So that's the major difference is banks
Okay.
are now verifying all of the finances.
Yeah.
Whereas before, if you had a good credit score, they'd be like, you're approved.
Yeah.
And then you're like, I want to buy another one. Okay, you're approved again. And what happened is people ended up getting into houses they really couldn't afford.
Oh, gotcha.
And then on top of that, the programs that were out
Mm-hmm.
didn't help. They were adjustable rate mortgages.
Yeah, there you go.
And then that rate adjusted, and then they ended up being stuck in
And
a
they couldn't
house
pay it.
that they can't make the payment. On top of that, the value's not what they had initially purchased at, so they might have been upside down.
Yeah, yeah.
So now they borrowed more, right?
Yeah.
And now they're upside down.
And they can't
now
pay the
the rate
mortgage.
just shot up on you. So it's like, what am I paying for?
Yeah.
And that's what a lot of people had to decide is, do I want to walk away? And they just had to see if that made sense for them.
Yeah, yeah.
And so that's kind of what happened on that scenario. Now, today, like you said, the main thing is everything is now being verified.
Yeah.
And they're sticking to the guidelines, and that's really helping.
Yeah.
And then the other thing that they did is they made appraisers third party.
Oh, okay.
Before they were kind of in the mix a little bit.
Yeah.
And it, again, there's too much mingling going on between the value of the house and the bank and what it needs to come in at.
Okay.
And so on top of that, these houses started being worth more and more and more. And then the more that these appraisers found a few more thousand on this house and a few more thousand on that house, that snowballed to where that's how prices got inflated. So it was really and everyone has their own theory. This is just my, experience of what I saw, is that those three factors all together just really was not a bad.
Just evaluating the whole situation. Yeah.
Yeah. So now everything's verified, and when you're looking at the market, it is not a bad time to buy right now, in my opinion, because again, the rates are high.
Yeah.
But those can come down.
Yeah.
But the prices did come down from the height of the market. So now they're at a point where they've kind of come down, and it kind of trend wise is slowly increasing again.
Oh, okay.
But it's slower and it's more stable, which is what you want. You don't want prices to shoot up like that, because that's when, again, they have to come back down at some point. But now with the new builds, like you said, they're coming in one after another, and they're slowly increasing that price along with the resale market. So right now is still a good time to buy, because you're going to get it at a better price than you would have a year and a half ago. Yeah. And then, like you said, once you get in, you can stick it with a 2-year window, which is the reason you probably were doing that, is because you avoid capital gains tax.
Oh, yeah.
If you sell after 2 years.
Yes.
So that's kind of the magic number.
Yeah.
And if you can get in now in 2 years, then you got more options. And then you can do, like you said, you can sell, you can rent, you can stay where you're at and refinance into a lower rate. Yeah. You've got more options. So that's what I would say as far as the market, and can I get into the market? Is it still worth it? I would say it is. Yeah. And again, everyone's situation is different, but if you're going long term, I think it's a good time to get in, because the main thing is you only lose when you sell. Yeah. If you stay and you make your payments and you're comfortable with that payment, while the market is doing this, you're just paying your mortgage and it's coming down. Then it's
kind of like lose. A marriage. Like, if you don't stay, you will pay. Money's coming out.
And you only lose if you sell. Yeah. Exactly. So as long as you stay in the game, you're gonna be good.
No, I think you're right. I was taking some real estate classes to get into real estate and to be a market a sales agent. And it wasn't necessarily what I wanted to do, but I learned a lot from the brokers that were there. And I remember this one lady, she was like 85 years old, been to through three depressions and recessions. And she said she never had a bad year in real estate, even through all of everything, even in 2008. She said, because every market there is an opportunity. She goes, you just have to know where to look, and you have to know what to do. And just like you're talking about the plan, I don't think there's ever a bad time to buy a house if you have planned for it. If you just wake up one day and say, "Hey, I want to buy a house today," it may not be the right moment for you until you put that plan together, locate where you're at, what you have in place, and then if you have an idea of what you want, then you work towards that. And regardless of what's happening in the market or not, if you've planned for that, you will get whatever it is you plan for. Yep. So it works. Works.
That's it, man. So anyway, that's just some initial information. We actually covered more than I was thinking, but as it comes up, these different things come. Oh yeah. And really just trying to give people some tips on how do I think about buying a house? How do I think about my finances? How should I be looking at credit, and taking a few tips, with your own personal experiences, and then, just the business experience, and kind of take what you want from that And then, like he said, if you guys have any questions, you guys are like, hey,
Yes.
this is my situation, or, anything like that. There is no stupid questions because
No.
you don't know what you don't know, and it's all new, and you have to start somewhere.
Well, thank you, Anthony, for coming on the podcast. We're going to have you back on. We'll probably do another premiere with that. And guys, I want to thank you guys for clicking on today's video, for watching. And yes, leave a comment down below. If you enjoyed this video, put some thumbs up and subscribe to the channel and hit that little notification button again if you haven't done it already, so you know when our next videos come out. We do all kinds of different things on this channel, and we hope that you were entertained and this helped you. So thank you guys again. And from my family and our faith, we love you. God loves you. Until next time, keep the faith, and we'll see you then.